Morning. Just taking a look at GBP USD this morning. And obviously we're using this tool, Liquid Vision Sniper, developed by an investment banker. So one would hope, just grabbing my coffee one sec. So one would hope this is going to be right. Although even investment bankers aren't right 100% of the time, as we've seen before. Okay, so the idea of this strategy is that we are not looking left. Okay, so we are not looking left to find an area of support or resistance, supply and demand, order blocks, liquidity pools, because they are not defined from looking left on the chart. Another little myth to put to bed is the fact that the banks can see the retail traders' stops. Your broker doesn't put your stop into market. It's not a limit. It's not a limit order, and therefore it is not visible to institutional traders. So what's happening right now? Let's take a quick look. What's happening right now is the London dealers spread at the highs. If I was to take that and drop some benchmarks, we're in benchmark 1 right now. We're dropping out of benchmark 1 at the moment. Benchmark 2 is down here at a lower price. I'd need to zoom right in to get that right if I was going to do this. And take that same level. So we're bottoming into benchmark 1. So benchmark is a formulated price area of generally support and resistance. It can be a liquidity fight, but generally it's a high probability of a reversal area. That being said, there's two of them. There's benchmark 1 and benchmark 2. Benchmark 2 can be hit on a very volatile day or a very volatile asset, meaning something like the Nasdaq would generally go to benchmark 2. It would acknowledge benchmark 1 but can go to benchmark 2. GBP USD usually likes benchmark 1, but it's trying to push right now. But the reason it's trying to push, I'll show you. So what we're seeing now is this would be defined as a trend, right? If we call this zone up here, for want of a better name, a manipulation zone, meaning price can go and do exactly what it's doing down here, and we don't really want to be involved in it. Trend starts when it breaks out of this zone. Go target 1, target 2, target 3, and this can be the end of the trend. And as you can see here, this is the place you want it to be: in, down, and out. This is not really what you want to be in if you're holding a trade. That's just going to be stressful. So that's what happened. These boxes are the sessions: Asia, Europe, New York, okay, Americas. So that's what we're looking at. So the London session was used for the London and New York benchmark, right? So that's how it is. We didn't look back. I mean, we could do, right? I mean, I can put this area on a chart. I'll take this off. So roughly, I don't know where that is. That's yeah, that's about right. Bring it up a bit. So if I put that on the chart, and can I extend a rectangle right? Yeah. So if I extend it left and right, so if I extend it left, now this was predicted from the formula at the highs. So this support that you're seeing currently is from this area here, formulated, okay? This area here formulated this support or supply, whatever you want to call it, okay? Now, if we look back and follow that rectangle, I'm sure at some point, I don't know how far back we'd have to go back to a higher time frame, that, yeah, there we go. Right, that you can see we've had support here, resistance, resistance, support, and support and support. So I don't know, like, why that is a coincidence, but that is a coincidence. Okay, so the reason we have that zone is because of the London highs. If we look back to the highs the previous day, you can take the spread from here to here, and again, you're going to predict the next session or two, and here it's 2 days, so you're predicting these areas. Again, you've come down into benchmark 1, and literally you can argue that then the following day just done nothing but retested that, and again we're going into the 3rd day where we haven't broken the lows of this benchmark yet. All right, so it's the start, generally the start of sessions that dictate the area of support or resistance, which is something that is not in the retail space is not recognized. Even some, even some of the trending order block courses and stuff that's out there at the moment, that's kind of trending in the course world at the moment, is still based on looking left, right? You're looking left for a green candle before a bunch of red candles that drop, and saying that is an order block. It's not driven by the color of the candle. It's driven by a formula, as I think it just makes sense, right? So in any case, if I was looking at today, we can see what my expectation would be is that I know we are still looking at benchmark 1. I know we've got a benchmark 2 down here. We can mark it up. Right. If we was to think, oh, where are we going to go from here? Where could we go from here? We could go down here. Now you can see this gets very specific down here. Oops. So it gets very specific. If I can just stop that extending left, right. So we get very specific down here. A very tight range that's liable to ping in and ping out if we get down there. Does that align with the highs? We'd have to bring that in. Take the highs. This is Tokyo was the high session. Okay, so there's 2 sessions. There we go. And remember, this is not saying that this is where we have to go, right? This is an inducement to effectively attract liquidity at these levels. Okay, there will be liquidity at these levels that will appear if we come down here. It may not be there at the moment. So in terms of how we're going to play this, the institutions have a job to do. I'm just going to take some more coffee, bear with. Okay, the institutions have a job to do. The Asians have a job to do when they come in. We don't just employ people around the world just to sit there and do nothing. Okay, they're certainly not sitting there looking for retail traders stops. All right, so when Tokyo comes in, Tokyo's main job is to execute the orders coming in from Hong Kong, China, Singapore, Tokyo, and that is sometimes quite low volume. When they have high volume at certain points in the month, you can see that on the chart, and Tokyo will have a wide range, but generally it's quite well known that Tokyo is the smallest range. Now, in terms of best execution, when London comes in, the benefit that London gives to its clients is a nice price away from that is current. So if we're moving here in Tokyo, and you can see that you've had a low and a high in Tokyo, and then it's pulled back, right? So that's why we box these out. Now, the question is, that London high there, before it happened, is not known to the retail trader, right? Because at that point, you're here. So I'm in the UK, 6:45 a.m. You're coming into 7 o'clock when Europe's going to kind of start placing some orders. Now, what we should know is that this is being treated, there's two ways to look at this. This is being treated as a dealer's spread, right? Tokyo low to high is formulated. Okay, so we can take Tokyo's low to high right now and say, right, that would be best execution. From where the price currently is right now, 1.2424, 2427. If I've got some sell orders to do, I don't want to sell at this price. I want to sell at a higher price. That's my job. If I've got buy orders to execute, I don't want to execute them down here. I don't want to pay that price. I certainly don't want to pay this price, but I definitely pay the discount down here. So that, again, is formulated. And if you take the New York low and the spread, the dealer's spread from the New York lows, and predict that, you can see you have a benchmark up here. Okay, so that aligns with the fact that I would expect institutional orders to be around this area. Okay, and I'd expect price to come back down into the Tokyo range or cross the Tokyo range to the downside. This is the New York low. The Tokyo low is here. So if we're going to execute buy orders this morning, that's where we'd be coming down to. Now, we know we've got a benchmark here that we've called out earlier, because we know that when we play this, how pinpoint accurate it kind of is. So you could get some volatility in. Now here, you can see you're pushing the Tokyo highs. And there you go. Those orders have just been filled on that candle, and now you're going to come back. And that's why you don't want to get involved in this breakout, because retail traders that are trading this breakout, they're walking into a wall of institutional sell orders, because we want a best execution price. We want a better than a market price. So that's kind of what we're seeing right now. We're in this benchmark. We're pushing out of the out of the New York lows. So if we're going to push Tokyo's, New York's so close, why not take that out as well? And that's what we're doing right now. So that's kind of what I would look at every morning if I was you. I would be looking to take Tokyo and range it out. Whoa. So, and the reason I keep we can do this again. Let's do this again. I didn't realize I was doing Friday there. Right. Let's pause this. Let's do today and see if we get a similar thing in. Similar thing happen here, right? So there is the Tokyo zone. Okay. And we have lows out of New York coming here. Okay, so we see a target one line here, and we have a benchmark just up there, right, which is kind of mid New York session. What we see here is, if we're going from this low to this high, what's holding Tokyo is this. It's this level here. Okay, so Tokyo has come into a liquidity pool that was generated by the New York lows to Tokyo highs. So New York lows to Tokyo highs is a liquidity pool sitting right there, bang, which will be formalized for the lows of Tokyo. So that's good. We know we've got the lows of Tokyo there. That's fine. We've got the highs of Tokyo. Now we're going to come in and take the spread from Tokyo and say, right, where's the manipulation zone? Manipulation can occur in this area. Coming into Monday, which means in or around the highs. Okay, so remember, there's not just one bank in the world, so that, you know, there's no collusion going on anymore. So this is just the orders that we expect are going to be in or around here to come down into that benchmark again, possibly across a little bit, because we have this manipulation zone just below the benchmark, so we could wick out of the benchmark and come back in. All right, so that's the possibility. And if we look at what can happen this morning, we go to Tokyo's highs. Now we don't tap in to best execution, so we need to understand why we think that is. And right now we are at these lows, so we didn't tap in when we could have easily tapped in to best execution prices, and we didn't. So if I'm sitting there as a banker with normally a bunch of buy orders and a bunch of sell orders to execute, I didn't really execute my sell orders this morning at best execution unless I have more orders and I'm going to execute them later today, in which case it would probably be New York. But for coming into the London Open right now, I just took the Tokyo high price. The question is, was that enough? I didn't need best execution today at that price or not. So we're now coming down to these lows, and we're still in what I would call the manipulation zone of Tokyo. So we can stay in this zone all day. So we could come to the bottom of this zone, execute buy orders. Now if we execute buy orders down here, it should be a rapid turnaround and run to the middle of this, back to this zone or to the high. If you play around at the bottom, very likely you can fall out and continue. So we are in a downtrend for the past 2 sessions, for the past 2 days. We stacked sessions. So stacking sessions is the definition of a trend day. So we stacked Tokyo, London and New York stack, block, block, block. You pull back in, you pull back in, and then the session continues in the direction. That's a trend day. What happened on Friday? We didn't stack. We sweeped Tokyo and we come back down and sweeped London and Tokyo for New York. You could argue London and New York created a downtrend. It's certainly put in lower lows, but it wouldn't be a great definition of trend for me, like this day. So right now we have not rejected off of these lows. But I am expecting there to be orders scattered around here. Yeah, so again, we're going to have orders scattered around here if we have a whole load of buy orders, right? Remember, our sell orders were not done at best execution. Will our buy orders be done at best execution today? If not, if there's just a little perk and it comes back, then the likelihood today is we're going to continue this trend. The moving averages I'd go into separately, but effectively it's another visual. Doesn't work as well as the formulas, but it's kind of like the 21 EMA is kind of is a benchmark itself. It is a benchmark itself, if you like. Yeah, we'll just leave it at that. So that's where we are at now. Is we know we've got a benchmark here, and we know we've got a benchmark here, and we have a manipulation zone here. The manipulation zone isn't actually manipulation. It just feels like it if you're a real retail trader, like trading breakouts, because right now you're breaking the lows. Right now we are breaking the lows. If I take that out of the equation, right now you're breaking the lows. Right now you want to get short. Retail traders are getting short at this moment in time. If we drop this down to a 2-minute chart, we are currently breaking out of the London lows. We are breaking out of the previous day's lows from Friday. And the question is, are buy orders being filled right now? Do buy orders come in right now or not? Because that's what we have right now. That's where we're at. So the first thing that we need to red flag is that we didn't go to a best execution price for the buyers, which probably means there's more money to be made on the sell side. Now the question is, do I have buy orders sitting down here to bring us back in and possibly then go for it in New York? But if this fails, the rule is, like I said before, it doesn't matter what way round you're looking at this, and it works literally intra-session as well. Here, if I change this to if I mark these up as try and get a colour that's going to eat through the red. Right, see there? Here, an aggressive move out. That would be manipulation. You didn't get any at these highs. It just come off the highs of Tokyo, which was formulated from these lows in New York. And when you break out of that what I call the manipulation zone, but it isn't, you know, it just feels like it. So you break out the manipulation zone and you run. Bong, bong, bong. It acknowledges benchmark 1, then says see you later, and goes straight to benchmark 2 and bottoms out. And we know why it bottoms out. It bottoms out because of the other aspect that we're looking at here, from the lows to the highs. We've got a liquidity pool. Bang, 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 off. So you'll notice I'm not looking left. I'm going back in time to show you, but from this low to this high, I'm predicting forward, right? It wasn't at this point in time, price hasn't got down there. I'm going from this low to this high, right? It doesn't matter if you say, oh, it's the low's down there, it's fine. The low's there, you keep tracking the high until you get there. And then when you get there, you can draw another zone and say, well, right, I'm not getting long. That price is too expensive. I'm not getting long. I want the discount. And this is where price will come in to get the discount. And that's where you get it. You just got to wait. There it is. And it wants it. You can see it's aggressive. It's like a magnet because it's formulated. But I haven't looked left to say, well, one sec. What have I got to the left that's going to predict this? Oh, I've got this little area here that could predict that. I've got an area up here that could predict that. That's not how it's done. It's done by taking the lows, getting the spread from the lows, and it predicts the highs. There. Where do you want to be? You want to be, this breakout is as aggressive as this candle is, this bull candle, for a reason, because it's breaking out of that zone on volume, and then it continues until it gets here. So that's the meat of the move, and that's where you want to be in. You do not want to be thinking, oh yeah, we've just broke that high, I'm going to buy, because you're walking into a bunch of sell orders. Okay, so back to where we are now. Exit replay mode. We've got so many boxes on here now. We just got a red wall. Right, okay, so what has happened is Tokyo. We only hit the highs of Tokyo. We didn't go for best execution in London for sell orders. We come straight down. We had the low of Tokyo, and this orange line is the low of New York session on Friday. We've just taken out that into best execution buy. But for me right now, that is not a hard enough reaction to that order. I would expect a huge amount of orders to be down here, acting as liquidity to stop those buyers. Now, there was a rush down to it, which is what I do expect to see. So I do expect to see a rush down to it, but I also expect to see a rush back from it. So as it is, the Blue River's just holding, and the Blue River is it's a visual of the liquidity pools that you normally see. So these liquidity pools are normally, let's get rid of this for the minute. I know it's there. Well, let's push it over. Okay. So when you're working your way through a market, in a sideways market, this is what happens. Let's get some of these. All right, low to high. Where's the liquidity pool? Here. Okay, bounces in, comes out. Now, then got most recent high to low. Come down. Whoops. There it is. Liquidity pool. Come in. There it is. Liquidity pool. Now, at some point we're going to get a double bottom in a session. But this one comes down, holds. Liquidity pool comes off. Now that's because this swing held, fouled. You come back to it and then you carry on. Now, if you was going to continue a trend, you'd carry on, but you have to break, obviously, the previous low. So now what you're looking for is, well, okay, am I going to continue that downtrend in the next session or in this session? And you're going to take the next swing and it's pretty much ignored. Break above, pull back to it, and then you go. So now that's a definition of a change in minor trend. So what we was doing here, couldn't put in lower lows. We kind of double bottomed. So we're definitely not trending. As you can see by the moving averages, you're not in a trending session, but the liquidity pools are there. But you eventually get trapped, right? In this price action, you're getting trapped here, between here, and you're getting trapped. What? There. And it blocks you in. And that's what forms like classic patterns, like pennants, that kind of mean nothing because the retail trader needs the one or two, 3 points to draw the pennant from, to draw the lines from. Whereas if you've got this tool, and a lot of the time, by the way, it goes by the first swing, not necessarily the high, the first swing, but that's getting a bit advanced on how you use this tool. It goes by the first swing up, then you come in, and then you get pinpoint. But it doesn't really, it kind of works either or, but a lot of the time the first swing will be ignored and come back to at a later point. So that's what's happening. And then you'll see, and this is kind of a classic, the trend changing, and you can see that this swing here, we did not come back to it at this point. Yet it moved up to this swing and used this liquidity pool here to continue on up. Yet we will come back to this, and we did there, bang, and it fails, and that's where we go to the downside. So that's Asia, and now we're coming into London, and London says yes. First swing, didn't touch it, ignored. Second swing, right, so the whole of the first London session got ignored, leaving us with an area here that has not been tapped into yet, but should be. And it doesn't have to be this session, but it's predicted from the London open session. And like I said, we know from the dealer spread at the opening of London, there you go, we're coming down to that here from the London open spread. We've gone in once, come out, and we've now gone to benchmark 2, and we're close, right? So here we're either going to bounce around. I'm not seeing the big runoff that I expected into the middle of the Asian session. I expect to be up here shortly. This looks like you could sideways into New York, sorry, and then run, or there's no best execution sell orders to do today. They're just going to take market price. Well, they won't take market price, but they'll take a higher price than what is here. They're not after these. They're not after this 124 100 level. I would be after that 124 100 level, I can tell you. Now, if I was after the 124 100 level, It's because it's formulated from Tokyo. Okay, I already said that's how we get this area to execute this best price to execute my buyers and the best price to execute my sells. What if I did come up here to get best execution on my sells? Remember, it was worked out and formulated from this price action. It isn't because I can see your stops above this level, right? You get what I mean? Let me take the fill out of here. All right, let's leave that there, that box there. So this is a liquidity pool currently of the London down session. Here we go for another stab at the lows here, or not. We could just literally continue to the downside right now. So we've acknowledged it. The question is, are we going to kind of like, because what we'd look to be doing is either double bottom here, which we will do. Well, which we'll test. It's either a double bottom. What I mean is we will do, which is right there. If that's ignored, you're going to continue. Or at least double bottom. So to continue, you have to put in a new low. So that's what we're watching right now. But back to where I was saying about how we're going to feel about stop hunts. So everyone calls them stop hunts. We took the Tokyo range and said, there's best execution prices, okay? Around there, I think we took that here. Right, anywhere in there is best execution prices. Now, that was literally on a formula from Tokyo. Now, if retail sellers have sold anywhere here, you know, those that were lucky who sold the double top, you're in the money right now. Those late to the program that are not early birds that are coming in at 8 o'clock London time can see a downtrend going on. They've probably got in on a pullback and you're in the money. All that has happened here is institutions have not executed sells at a better price than Tokyo. Whereas generally they like to execute at a better execution price than Tokyo. So here is still the expectation for me. If the bottom best execution price for buyers holds, and we do, right, so, and this is what we can do, right? If this swing was to hold, we can see this benchmark is aligned with this liquidity pool from this downswing that we drew earlier. So that's a very high probability. That still doesn't take us to best execution prices. What would take us to best execution prices and then some is if we come to this level or this level. Okay, and remember, this could just be a wick, right? And then we come back in. So you could just wick above here and then come back and you're done because all the orders are filled. So if, for example, imagine we have some, like, I've been drawing it like this, haven't I? We have some orders in and around here, but now we know from these lows we could wick up and have some orders around here, and then we could come back in for the day. Okay. So imagine that's there already. So you have a pool of liquidity, a pool of orders sitting there. Limit orders sitting up here, which means I've got liquidity sitting there, meaning I've put a sell order into the market. So I've provided liquidity to the market because that sell order would be sitting there and those sell orders would be matched with buy orders. Now, whose buy orders? Right? Those sell orders could have been sitting there all morning. But if price comes up here now and works its way through from here, acknowledges the top. I'm going to need to take that out. Comes back in, breaks out, and works its way up through these levels now to here, and then breaks out or even wicks up. At that point here, you're filling these limit orders. Now, the retail, you don't even have to ask where their stops are. That's where their stops are, right? That's where the retail stops are. Your stops are not put into the orders as liquidity, as limit orders by your brokers, meaning we can't see them on the depth of market. So they're not there. No one can see them. But just by the nature of the way that institutions do not pay market price for something, but they want the better price to be executed at the lows and the better price to be executed at the highs, by default, what they're doing takes your stops out. But it's not specifically a stop hunt. It just happens naturally, organically, because that's the formula. So if all you take away is wrapping a box around the Asian session and saying, well, do you know what? If I run above that by like 20% or I run below it by 10%, I'm not getting in. I'm not going to do that. I'd rather sell the run up 20% above this area or the run down 10% from this low. I'd rather buy that and sell that than I would get involved in the manipulation area. Now, what's got to happen for this trend in London to continue, for New York to continue it, is to break out of it. But we do know that to break out of it, we would need to double benchmark the day, which means London's highs have a smaller spread here than the Tokyo ones, right? Tokyo has quite a big spread. So Tokyo hasn't finished. His benchmark is down here. And in fact, to define that correctly to the lows, is the lows of there. So you could literally argue, oh, we're not done for the day. We're literally going to stack Tokyo, London, New York down here. And that's highly likely right now, even though we are acknowledging the buy orders at best execution. So we're acknowledging the buy orders at best execution. But, okay, let's come back down to what we did say here. Was we're taking the low and we're taking that higher, and what needs to hold. Right, so we literally have gone in there once, twice for a test. This needs to run off, but time of day isn't really aligned with when this runs, right? We've seen the London run. The London clearly is putting a bearish run. Now, is that inducing other sellers, or are we executing best execution? Now, if we do it now, if London's going to continue, it's going to break here. And then if you break here, you are out of that zone. Give or take a double bottom. We can double bottom into this and come out. But right now, I'm not seeing the buy volume come in here as I would expect to see. If the buy volume was coming in here, it would do this. 1, 2, potentially 3 hits around here. But then it's bang, 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 bang. All right, you can see the momentum come in. Right now, it's enticing sellers. Okay. Enticing sellers. Sellers are getting in because it's a pullback and they're getting in. And Question is, does it hold? But I'd rather be getting in long here than I would be selling here, because from a London perspective, we've literally completed a trend, an overextended trend. But we know that Tokyo had a bigger dealer's spread than London, so we could go for London. Now look, there we go. So that'd be a nice buy for me right here now. And if I see some volume coming in here, that would be really nice. But if we don't come in now, that's going to be game over after 3 tests for me. All right, 1, 2, 3. That's the kind of rejection I want to see, but it's got to follow through. It's got to follow through. Now for something else that this tool does that was developed by an investment banker is, and unfortunately I can't change the trend lines to right. Here's another one that's going to, say that you can trade without looking left. It's a bit of a surprise to retail traders. But if I just do if I just put this over everything for the moment and mark it up as white, for example. Right, so let's do that because you can see it. So from lows, first swing from lows, you can predict trend lines. And in order for this liquidity pool to work, you have to break above the trend lines, and the trend lines have to start holding. So if they don't, then like I said, we're heading for Tokyo benchmarks, not London benchmarks. But right now, that is what needs to happen. Now notice I've used the low to the high to predict the trend line. I haven't used 2 points on the chart or waited for 2 points on the chart. So now what I'm going to do is take these closes, so the low to the close, and then we're going to say, right, where's manipulation? Right, so I have this top level here we can go for. We probably will hit this. But I have to break out of it for me to head towards this liquidity pool and potentially then above to the best execution to execute sales at a better price, much better price now than where we are. So see this coming in now? That's the sort of volume I want to see, but I want to see it break out of here. So we've touched in here. If this is just a pullback in this downtrend, we're just going to reject it. If we're going to start a trend to the upside and start putting in higher highs and higher lows, we have to break this level. You have to break that level. Otherwise, you're just going to potentially sideways for the rest of London. See, not once have I looked back. I'm literally going to draw that round. And say, that's what I want to see happen right now. I want to see that breakout. Drop them down to the 1 minute. If this can base that candle, that would be beautiful to hold, to push to the upside. That one here. You can base this. to push to the upside. But if we can't break out of this level, we are not going to do any upside. And exactly what we've done here, right? Because this is a spread at London lows right now. This is the dealer's spread at London lows potentially. But the formula that runs is the same from macro to micro to nano. And nano being high frequency trading, nano being it's exactly the same formula, but as a human you can't leverage any profit out of it because of your spreads and literally because of how narrow and tight that range gets. You'd literally need a machine to execute it for you. So here, for example, right, if you can see this, we come down, we came up, and I use closes a lot of the time. A lot of the time I use closes rather than wick highs, because line charts would kind of, that's what line charts would be. Line charts would work on the close, not the open. But that's neither here nor there, really. So I would go from the lows to the close highs and go, right, if I want to join this trend, where am I getting in? And that's where I'm getting in, because we didn't break to the upside, we held and we broke down to the downside and we hit this level here. And this level here, by the way, has literally like a 98% chance of hitting if you break out of that manipulation zone. So that's where it is. It's the same formula. It runs all the time. If you look at any kind of pullback in a trend, it's the same formula. If you take a low to a high, there it is. That's where you get in. Bang, comes down. And they are tradable for humans, right? These are tradable for humans. But this is a time chart because that's what humans use. If you go down onto a tick chart, which humans can use tick charts, but by the time you start seeing these swings in a tick chart, they become so small that they're not tradable. There's still edge there, but they become so small they're not tradable. All right. So yeah, you got kind of got to look out from really everywhere, like even to the downside. You can take one here to there. Yeah, see the pulls, and you just come into the bottom. That bang into the bottom there. Now here is that last leg high. Last leg high. First push forward, very close together. Uses this one. Comes back in, goes to the highs, comes off. So it's used to the upside and the downside, which is what predicts those areas above current price and below current price, which everyone calls stop hunts. And it does do it. It does hunt stops. It does take stops out. But the one thing that retailers like very rarely do is wait for a good price. It's like the market sold off from the open in London. Let's take this off now because that was just to show the trend lines. The market sold off in the whole of London. And this push here, I can guarantee you retail traders took that push as they took this push. So that push means it pulls back. That push means it's pulled back. It pulls back. And we're kind of struggling to break out of this box at the moment. I'd love to break out of this box at the moment. But all that we've got to look at the moment is, right, what is standard? We know that if we're talking trend lines, that's where we are. Here we go, we're coming back in, but we can go to the trend line and then bounce off. And again here, there'll be another attraction of liquidity from this swing low to this swing high that would be textbook normal to take out. Yeah. And that area there is going to more than likely align with one of these trend lines. Okay. So this may not hold. It will come down to here. There'll be a trend line here. You've got a liquidity pool there, and then off you go. But you have to wear it, right? You've just got to wear it sometimes. And this isn't enough of a breakout of that zone to say, yeah, we're committed now to putting in new highs. And not to mention, like, it's kind of like here, right? This is just normal to pull back to this level to continue down, and we've got one here to say that was our last swing. We're in that zone now. Look, we're in that zone now. We've broken out of the trend lines to the upside, which is good, but there we are. We've held. This is a liquidity to say that sellers have held this liquidity. There was enough sellers in here to push it down. Okay, and this is where I'm saying we can get trapped and you can start to build what's commonly known as a pennant, but we're building it from formulated price action now, not looking back. I'm not looking back to see this level. There's nothing here or here that's telling me this is the right level to play. I'm literally taking the high, I'm taking the low, and it's formulated to stop here. Now, what can happen? We don't know, right? It depends on the volume of orders. That's the way. We can't see what's on the desk. I can't tell you how many orders a particular bank has to execute as buys or sells. What we can identify is where. If they did, where would they be right now? So we know we've completed a downtrend, and that we could continue to fulfill Tokyo's downtrend because Tokyo's dealer spread was bigger than London's dealer spread. But the London trend is done. Now the question is, does New York or London still have orders to execute, buy orders lower, which means we're going to Tokyo's benchmarks, or we're going to have some sell orders that we want to execute higher? And this box is key, and this is key, right? Because this is, come on, what's the matter? This is a seller's hold level. I've got red everywhere, but you know, this is a seller's hold level, and this is a buyer's hold liquidity. All right. So if we break out of the seller's hold, meaning the sellers don't hold this downtrend, then you can hand it over to the buyers. Or, so we could do this right now, because this is what's happened. Come up. What happened? Where's that? Oh yeah. Get rid of that. How can't I draw that? Let's go again. Come up. Come down, because we had a liquidity pool there. Now we've come up. Now we haven't come down to this liquidity pool yet, but we can still do. And then we could literally bounce between these two and form, you know, a squeeze and a pennant. And that's when you start drawing your pennant. Oh, like, you know, we're in a downtrend. This pennant's going to work to the downside. Not necessarily. Or you can not do that. And we can go, and let me draw this one in just to show you. Yep. All right. So that's how this is going to play out. You're going to go. You went up. Buyers hold. you went up, you didn't come down to buyer's hold. Now, if you don't come down to buyer's hold, that is a suggestion that you're going to leave it there for later, right? That you've got, there's something else on the agenda. But still, I mean, that does look like it's confirming out of this zone right now. So it does look like that at this point, sellers have not held the downtrend. Buyers didn't come in. We didn't need to grab these in order to go up. So we could have a run to the upside. But you could still fail, because if we put this on a 5-minute chart, this could be a wick, right? So just need to bear that in mind. But textbook would also come down here, and again, if we're not playing the pennant trap game, we break out to the upside, and there we're in what I explained earlier. So hopefully that's making some sense. And like I said, the British pound is one of the major currencies that plays benchmarks quite perfectly. When you get into cross currencies, they don't play them as perfectly well. The formula's kind of skewed a little bit, but generally the majors do this quite well. Yeah, so right now, what I would be looking at is seeing that we didn't need to come down to this buyer's hold level, and that we're progressing to the upside at the moment with some sort of conviction. And if I was to do that, where am I heading to? So I would want to see this level touched aggressively, quickly, now. Yeah, I'd want to see the next few candles, 1, 2, 3, 4 candles, get up here. Actually, on a 2-minute, I'll give it a pullback, right? So we're going to we can pull back to that level. Remember, we've still got this level here. And actually, if I'm down on a 1-minute, like I said, we didn't go to this level. Yeah, we didn't go to that level. But this level still needs a pullback, right? So we can pull back to here to continue to here, and that's the thing. That's always ongoing. So, and that's why you're always getting this. Oh, I get into a trade, it goes against you straight away. That's because even if you like the look of this bullish candle now for the upside, buyers are still holding down there. We know there's liquidity there at a better price. There's always a better price to be offered. And yeah, for some reason, it's like retail traders, if they're going to buy a car, they want the discount. If they're going to buy their groceries, they want the discount. They want 2 for 1. They want the special club card price or whatever it is. You always want the discount. And then they come to trading and they just buy highs. They just pay a premium when they're trading because of the emotion that's involved, because we're all greedy. But actually, when you're doing this as a business and saying, well, okay, wait a minute, I'm not executing for me personally, and I'm not going to personally make any money out of this other than the salary I'm being paid to execute client orders. But my clients want a better price than current all the time. Otherwise, there's no point. You'll lose your client. So if my client wants a better price, I'm always going to be buying a buyer's hold level. I'm not going to be buying now. I'm going to be buying here, or I'm going to be buying here. And it's just a few cents sometimes. It's just a few cents, but just if you concentrate on saying, I just want that extra few cents, then that can turn your edge into profitability. But listen, right now, we are testing the backside of a seller's hold level, knowing that we have a buyer's hold level here. Now, if we punch into this buyer's hold level, I'd like to see it react instantly. Obviously, well aware that we have one down here that we could tap into first. But if we're going to have aggressive upside, they ignore the first one pretty much. Now, this is the second one because we're looking at a minute chart. But if we was looking at anything else, you know, you got one coming. But we're looking at the micro version of everything right now. And like I said, if we're going to break out, it's generally an aggressive move once you've done it. The question is, are we wicking? If I look at this on a 15-minute, right now, it's a candle breaking out. Quite easily, if we come back down here now, that would just be a wick. But that's what I'm looking for. And like I said, where I'll be looking to go with it, as predicted before, we're taking that spread at the lows. I'm using the closes and looking to get some sort of parity up here, and there's benchmark 2 above it. And that benchmark 2 above it, let me check. Yeah, like I said, that's right. We said before, it's a little higher than where we was on the Tokyo's upside, and that could well be because now we're forward in time, right? So now what we've done with Tokyo's range, if this is a London low, which it is currently, if you took London's high to London's low, where would it come in? Up there. What is that? Let's come down. 24.25. So that's 24.25. And if we're looking for benchmarks, look, okay. So we can benchmark the London session just like we can on the Asia session. So this could be a run to the upside if buyers hold levels can hold, right? Because like I said, the first problem we're gonna encounter is this seller's hold level up here. That's our macro London. All right, that is our macro London. So to get up here, you literally have to bust the hell through there in order to get here, or which is the Tokyo, or to the London. Best execution for sells. Now we know what's happening. We're in a downtrend, but if you see a prior day, look, didn't get out. We just literally ran the highs and then ran the lows just of Tokyo. Now look, you get the same low of Tokyo as the same low of London. So if we go and take London and Tokyo, that's where we've come into this morning. That's where we've stopped this morning. And if we just take London, it's going to be the same. It's going to be the same. London's going to be the same, right? It doesn't matter which way you play it. It's going to be the same. That's where you've tapped into this morning. So literally, the sessions prior calculated. So this area of price is what formulated this support, not looking back on the chart, not going, as we've said before, and trying to find it going back. There we go. And that's like what I said before. There's enough reason to say, I'm going to look back on my chart and say, oh, that's a low. And say, well, I'm going to, you know, this is where you can't make up a reason for that. It just didn't work there. You can say that did work. You can say that worked. And that didn't. You'd probably say that did. But you can put that anywhere on your chart. You can put a line. Yeah, I can move this. Like, I don't know, put it somewhere down here. Like, you know, where is it now? What happens? Oh, you probably have to go back away. So I'll put it back higher. But I don't know, can we not see this? Oh no, I thought I could hide my price, but yeah, just random junk it anywhere up there, right? Junk it anywhere up there. There you go, some there. One there, look, one there. But I just threw it up there, and that's it. So like I say, I can't. No matter where you are, there's only a certain amount of resolution on your screen. But if you look at the price data, just the open, high, lows and close, open, high, low and close, that price point isn't looking back at another price point. It just doesn't. And the algorithm don't look back at a current price point. And high frequency trading is formulated from the macro level. It's just that executed at a nano level. The formula is exactly the same. Exactly the same. It's just kind of becomes invisible, like not visible to the human eye, because it's the tick that's in the chart. I don't know if I can even. I've got this open. Let me see if I can. So, if I was to make this a tick chart, oh, it is a tick chart. But if I was to make this a tick chart that is not really visible, so it goes intra candlestick, right? So, let's make it say 250 ticks is like a 1 minute chart. Ticks. Let's make it 100 ticks. So 100 ticks, you can go less than this, but if I look at this now, this is on the NASDAQ. If you zoom in to these ticks, and this is probably just about human executable at 100 ticks, but this wouldn't be necessarily, that's only because the market hasn't opened yet, right? We're kind of in pre-market for, well, futures is open, but you know, the New York Open is hours away. But if you kind of look at what I was saying here about the first, you know, when you get some volume, the first one can be ignored, right? So we're sitting down here. That's ignored. But when you come to the next swings, they start to tap in. Yep. They start to tap in. And at this level, you can really zone in, right, by not accounting for scale per se, and you can literally go right, lose the arrow, and you go with the crosshair. Just to get a little bit more accuracy on the tight time frame. And same here, coming up. Now with the NASDAQ, that's any sort of pop above here, and this is where I say, right, on the Nasdaq, this is where you got caught. We've got a level here, buyers hold, yeah, and sellers hold. Again, sellers hold. This one, sellers are holding. So right now, sellers are currently holding. But if we take the full swing, there's our buyer's hold level. And I would argue that's just tucked in. My scale's a little bit off here. It's a bit awkward. But yeah, we've just tapped into that. So a seller's hold, so this is where you're forming, you're getting locked into a range because you're forming shapes, rectangle, right? Because you've got one there, you've got one there, and you've got, this is kind of micro and macro, and pretty much do nothing right now, right? Wait until one breaks out and shows you direction. If we look at the Nasdaq, what direction have we got this morning? Not a lot. Not a lot. It's pretty much right. Okay, so sellers hold. That's a nice trade there. There's plenty of money in that one. Can sellers hold again? Well, they certainly held that swing. There, another trade there. Second attempt, same trade though. Yeah, and this one, look, sellers hold, sellers hold, sellers hold, sellers hold, sellers hold. It's the beautiful thing about trading before the New York Open is that it's easier to trade in terms of the buyers hold. Like you can sell this 3 or 4 times, that once, twice, 3. We don't normally have a huge trend in the Nasdaq in London, but it does operate the same, and we'll have a look at Nasdaq. We'll have a look at the Nasdaq in a sec to show you session by session how that's working. But yeah, you can just literally go, right, okay, we've got a seller's hold level up there that is clearly working, and now what's happening on, oh man, what's happening on the buyer's side? Well, on the buyer's side, we've obviously been failing. Almost a fail there, right? And then bring it in. Or whichever one, actually, we should continue. Right. There. There's a buyer's hold. That buyer's hold was a macro one that took you to break out of your seller's hold that was sitting here. Now, does that mean the trend's going to continue higher? We'll need to do more analysis on a session basis. But each one of these, right, there, up, tapped in, there's a buyer's hold level to take there. So you've got a number of sellers, and if, like, you literally, your target, when you sell a seller's hold, your target should be the buyer's hold level, because it does it all day long. The trends that come in are few and far between. It's like once a day, if that. And the trends are a lot shorter than what retail traders think for a session. But each one of these, they play the same thing out and out again, every single time. That's that one. I'm looking at this one. This one kind of fails, right? Because we're on a different low. And that's it. But the macro level is just taken there, and you come down into it, and there you go to trade. But there's hundreds of dollars in that range. You just got to know where the buyers hold and sellers hold levels are. And like, we're not talking Fibonacci here either, right? Because if I was taking this at, can I do fib tools on here? So let's do this. Okay, right. So let's do a bigger one, because right. So this high to this low. Okay. These are the wrong way around, aren't they? Okay, so this high to this low is literally currently coming in about 65%, right? But the problem is if this, so if I was to put that on there, that's where this level is going to come up, right? Which is correct. 1, 2, 3, 4, and continuously works. Your fib is not your fib, because if this price from A to B was more aggressive, okay, yeah, your fib A to B is still coming in at 60, 70%, 50%. But your buyer's hold level is higher. See? So it's not the same. The more aggressive the move, the further away the buyer's hold level is. The further away the liquidity is. You have to go back further to get that liquidity. The longer and less aggressive that move takes, the lower the liquidity pool comes in. And that's the problem. I'm all for using fibs for getting a buyer's, for getting a discount, right? I'm all for that, because here, look, sometimes it's going to align, because you're just saying, yeah, I'm not paying this price. I'm just not. I want to pay at least 50%. Yeah, ideally, if I'm selling, I want to sell these highs or higher. That's what I really want to do. And ending up, that's probably what you can do, right? Nearly always, if you wait for the better price, you will get it and then go in the direction. So ultimately, I don't want to pay this price right now. If you're so eager to get into the market, you at least want a 50% discount. At least want a 50% discount. I want a 100% discount from where it is, or 120% discount from where it is, which means I want to be selling above these highs, because that's what the institutions do. I know that liquidity is up there because that's where the orders are. The fact that your stop's there is just your fault, right? The fact that your stop's there is, like I said, your broker doesn't put that stop into the market until the price gets there, so no one can see it. But I just want a better price. So if I want a better price above there, that's what I'm going to do. I'm going to sell that level there, 15425, and take that price. I don't need it to come all the way down. Yeah, there's $500 there easy. And yet retail traders don't. They just want to get in. But if you're going to do anything, at least want a 50% discount, because then at least you've got a chance of taking some cash out of the market. But if you're selling these lows and you're selling these lows, you're asking for it. You're just asking for it, because you're probably weak holding anyway. And as soon as these come in, any sort of pullback, you're gonna be wrong, right? And this is a few $100 pullback. You're gonna get burnt on that, unless you're doing micro E-minis. So yeah, now back to GBP USD, and yeah, we can now look and take that same area, and we broke out. I said what I say, 98% of the time you hit target 1. We then pulled back. We used, and what did we use there? Let's have a look here. Oh, I've got boxes all over the place trying to explain this. Yeah, so then look, one here. We went up. Let's forget these for a minute. One there that held. And this is what I'm talking about. We want to see the aggressive move. One here that held. Oh, we waited for this one. Here that held. Buyers hold. And then you'll be looking for another one. But if you was in this long, you'd be looking to take some profits because you're in the middle of the Asian session. But that's the next buyers hold. Let's not do that look left example. And that's it. So we come to the end of the London trend because we hit the London benchmark. We then had a buyer's hold level hold. The second one didn't, which suggests we can have an more aggressive move to the upside. And we are now, let's get our Asian box back. Let's get rid of this one here. I don't know what that was. Right, that's now we can see what we're doing. So we have a seller's hold level up here. We have our current buyer's hold level here. We are back in the Asian session. And the question is, are we going to follow this plan? Are we going all the way up now from London and New York to take out those Tokyo highs, the London highs, and go to the New York highs? But it was an uncomfortable buy if you was down here. Yeah, that's an uncomfortable buy looking at this. If you put that back in replay and play it, who wants to buy here? Who wants to buy here with what it's doing? It's only the fact this box is here, right, that I know is where the orders are. But how uncomfortable for a retail trader is it, look at that bar, is to say, I'm going to buy that right now. I'm going to buy that right now. And if a buyer's seller's level holds like that, I'm going to buy some more. And if this next one held, I'm going to buy some more. But if I break out of the manipulation, I'm going to buy some more. That's it. That's my trade. I can come back now. But ideally, I'd be targeting to get back to this area. All right, there you go. $369 in cash. That would have been, because we're currently at market price. So if I just get rid of it now, get rid of that one. There we go. Then that's it. Now it can go to this, and if I see the rejection here, I can sell, right? I'm not saying it has to go here. We might not have enough sell orders to warrant going up here for a better price. I'm well aware I have this block of orders to contend with. And only if we smash through this or have one attempt and then a second and smash through it is, are we going for these highs? But in terms of where liquidity would be, it would definitely be above here. It's just whether we're going to get it in this session or the next session. But yeah, you can see I have, the only time I'm looking left is to the previous New York session. Okay. And I'm looking at the highs. I bring that high forward, just like I've brought the high forward of Tokyo, because I expect to take it out. And London, I would expect to take it out. Right now, I'm looking at the highs for London to be taken out, ideally, if we can get through this seller's hold. If we hold this seller's hold, lows to be taken out. And that is it. And you can do that every single day. I said we'd look at NQ. All right, NQ. Let's have a look here. Right, the NQ's much more volatile to take, and sometimes the ranges have to be, you kind of need to use a little bit of expertise. Right, you need to have done your chart time effectively to look at these sessions. If you're not blocking out sessions, you are missing a whole load of information. Okay, so let's take these. Okay, so we're definitely in the manipulation zone still. It's quite wide because we had quite a wide session for the Nasdaq. Now, that being quite wide and this being quite early, really the Tokyo session for Nasdaq, you have to investigate this level. Okay, this low to that high, because a lot of the time you don't have another clear swing in Tokyo to set spread. But if there is another clear swing to set spread, and by clear swing I mean if I was going to draw a range to say high and low, definitely that's the high and low of the range. If I was to draw another one, I would be saying that's the lows and their highs, right? And you can average these out. But that's what I would be saying. So I would also be drawing, even though this automatic, session box is just killing it. It's like you got one here, one there, and you kind of average that. And then Tokyo, I mean, look at this. London session just opens, it pushes to the downside and takes out London's initial dealer's spread. So it takes out Tokyo's low, but it doesn't come into the Tokyo's best execution. But London's one, sorry. So you can see the highs once, twice, 3 times, 4 times. That's what I'm talking about. Them orders are up there. Anyone that bought the breakout of the Tokyo range is going to be in trouble because they're going to hit sell liquidity. It's not a stop hunt. The orders were already up there regardless. It was just you that put your stop above these highs. Now, in order to look for further liquidity here, you have to consider the London swing. And you still quite, the London swing comes into here, but it's just you have to draw that and be aware of that because they can align. Look. There. And remember, these are different swings. They're different swings. You just need to consider them. Like I said, there's more than one bank, right? It's the formulas are there. 1, 2, 3, 4. This one, not quite, but you did take out this low. And that's what I like to see. There's still going to be liquidity there. It just wasn't the best execution. And sometimes you don't need to because you might not have a maximum number of buy orders today to execute down there. So if you've only got one client there, bang them a better price than what they're seeing up here, right? Because we was here on the opens for London, right? 730, 414. Sweep below, 392. There's a discount. You may not need to go to 384 because you haven't got a shed load of orders to fill. But your sell side, you clearly did need that best execution price, which you got it once, twice, 3 times, 4 times. You went for that best execution up there. 4 times. And that's going to mess with anyone that's long. Now, let's take this. Lose it from that perspective. Lose that from that perspective. And we will look at it from this perspective and say, right, Tokyo's highs, latest swing, because we've got buyers hold, right? So one swing there. Tokyo, sellers hold, right? Sellers hold here. Comes down. With here, your buyers hold, holds, fouls, pulls back to it. Look at the trouble Tokyo has getting above what was previously a buyer's hold level. Right? Now, wait. You come to that's the most recent. Look at that. You literally got a buyer's hold and a seller's hold level, exactly the same place in Tokyo, that it cannot get above. It cannot get above it. Even London couldn't really get above it. And then it dumps down. But taking a look at this swing, which is, again, another dealer's spread. Look, the benchmark. Tokyo comes into the benchmark. It comes into the benchmark. Tokyo lows. It has a massive dealer's first spread at the lows. Big. Tops out. This is a manipulation zone, right? And this is what I said about the time. We're looking on a 1 minute, but we're wicking out. We're wicking out. We're wicking out. We're wicking out. Back in. You can't break out of that manipulation zone in order enough to get here, apart from this action in London. But if you come forward to London and say, right, okay, initially these were the highs. There's my dealer's spread. There's the benchmark 1. There's benchmark 2. Look at the run off that. Look at the run off that. And that's when I say, if this goes there, it goes there aggressively. And when it hits, it literally freaks off that level. And runs to the highs. And then to find it at the lows, put it at the lows. First swing. We haven't really got a nice close there. There it is. It runs up. You break out of that manipulation, bro. That's where you want in. That's where you want out. It comes back. This one will be so aggressive, whether you've got time to get it, neither here nor. That's in 1 minute. It went in 1 minute. It went from benchmark 1 to benchmark 2 and starts topping out, because we know that this level, which is a benchmark in price from the dealer's spread at the lows of London, is giving you that's where it stops. It's over at benchmark 2 for the session, right? But what come in to that area, yep, same. So the dealer's spread in Tokyo on a session basis, on that swing, that key swing in Tokyo, gives you the best execution price for sellers. The lows of London predicted the highs of London based on the benchmark. When the two align, game over. You're stopped. Get out of your long trade, get into your shorts, and then wait for the next breakout. So what we got going on here. So zoom in, and we have a London. It's not so aggressive. London sellers hold. There's a London trade on the Nasdaq for you. If you want to sniper right into that, might get better execution. Pretty similar. Not a lot in it, right? So yeah, there's your rejection. You get a bit of heat on that, as you always do with the Nasdaq, and it comes down. Now, what do we see? That means we don't get a. So look at the congestion there in the buyer's hold, buyer's foul. It goes to a new low. Now, what do we get here? And again, don't worry about it. Just goes on. I know how to draw these. There's two ways you can draw it, with the arrow and with the sniper. Normally the sniper is when you get down to a micro nano level. But nevertheless, there's not a huge amount in it. And plus I had to account for scale in this thing. So this is missed. Okay, that's missed. Whichever way you look at it, we missed that level. And when we miss that level, it can generally mean you have an aggressive move coming up, and there is the aggressive move coming up. But the fact that we went here means you can now go here to that low. Yeah. So you're going to pull that low and pull that high, and you can buy that one. And this is where, once you've topped out, and like I say, you've topped out, you've come back to the center of the London range now, and mark, until New York opens, and we don't know what orders are on their desk. Well, retail traders don't know what orders are on the New York desk. And you can go, okay, I'll play these levels then. Right, you got $500 in there. Trying to play these levels, sellers hold. Right, if I play this to the other side, smashes straight through, doesn't hold. Question is, does the macro? No, still not there. They're still left that hanging. So I'm guessing we are going to use that all the way along pretty much. So seller's hold didn't work. Fine. We put in another low. So you're going to take the low. Seller's hold. Take it to this one. Seller's hold. You see the minor one here is going to fail. So you're better off going with and they're not even macros, they're all micros, but what you're seeing here is what I showed you earlier in a trend. When you're going like that, it's the same formula, right? You're getting to those highs and lows. Look, that's a manipulation zone right there. Yeah, just tweak it. There it is, right? That is why you don't want to be in it, because it's a manipulation zone. And each one of these, all right, each one here, yeah, manipulation zone, bang. That's why buyers levels and sellers levels are not holding, is because that's the equation it's using. And again, this one, buyers hold works, doesn't come down to this side, right? And again, the reason the seller's hold level works doesn't work here. So it works there, but breaks it here. You come down there, yeah, breaks it there, is because you're going there, manipulation zone right there. Okay, so the formula's running all the time, and the formula is current. High frequency traders do not operate from looking left on the chart. Institutional traders do not go back and look left on the chart. If an institutional trader has got a whole bunch of buy and sell orders from clients on his desk in the morning, do you really think they look back on the chart and say, wait a minute, Bob must have his stop here. He must have his stop up there, because he would have probably sold that and put his stop above the nearest swing high. Let's wait for that before I execute all of my client orders professionally. No, that is not. We don't wait for Bob's stop. We don't see Bob's stop. Bob's not on our radar whatsoever. What is on our radar is the formula that we've got, that is run from the session, highs and lows, and the session itself, and the dealer spreads in each of the sessions. That is how institutions trade. Anyone that tells you they trade otherwise, it is not true. The formula runs all the time. The difference is whether the formula is being running from a best execution price, like who's the player, who's the actor in the system. If you're a dealer in an investment bank, then you're playing best execution. You're doing this is your job. That's your job. Okay, you want to play off these highs and lows. Actually, you can argue it's that one up there, right? Because we was looking, I'm thinking of GBP, right? That's your job, is to play these highs and lows. The second swing we averaged out this second box. So that's your job. That's your formula for the day. You'll also be aware of the benchmark. if you are a hedge fund and you have your quants, or you are a prop firm, the investment banks are not allowed to trade client money other than their executions for commission. So if you're any other actor in the market, you are probably concentrating on buyers hold levels and sellers hold levels, and what I'm calling the manipulation zone, right? Which means the spread is taken into account, and you're frequently trading all the time for your own funds, for your own accumulation of profit. You are not executing for client orders at that time. That is why the open and the closes are busy. They're busy with institutional orders. The rest of the time is full of formulated frequency trading based off of the same formula that is worked upon for best execution, but on a micro and nano basis. So by micro basis, let's say this one here to here. Yeah, so that here to here. Micro there. This is a nano. All right. This high, this low. It's here. Just here. Right. Boom. There. I don't want that big, can't see the candles. All right. Now, see? Boom, boom. Boom, boom. And if you're trying to trade away from those opening times, like, let's just say you don't know any of this, right? We don't have the tool. You're not applying just a generic 20% above a session, and you see a double top, right? Fine. You see a double top. You're coming down. You're expecting more because this is your double top. You're expecting price to come down here as a retail trader, right? That's your expectation. But from a double top, that high to these closes, that's it. You're finished. You're in your manipulation zone. You don't really want to be doing anything here because you've now got, well, a double top, a triple top, a quadruple top. Oh my goodness, I don't even know what to call that. But yeah, how's your double top playing out right now? It's not great, is it? It's not great because you're stuck in between. And not necessarily this one, isn't it? You're stuck right there. That's it. You ain't doing nothing today apart from waiting for that. And even if you took this high to these lows, that's why you're topping out in these ones, the inch ones. So yeah, price is trapped right now, certainly waiting for New York to come in. But yeah, I would not want to be in that. I want to be in this. If we break out of the manipulation zone at London highs, right? And there's literally two here. There's one there, one there. Yep. So I want to be in this and done. That's one trade and done. Okay. If I'm coming off the new low, I mean, there's one here. It gets a little bit silly on these swings, but one there. You could take that you could take that long. That's not too painful. You break out, you pull back, you go straight up there. You can have that. From this high, this swing low, go again. But and this would be the very last one at 8:20. So you've gone through now from 7:30 to 8:30, playing in the manipulation zone of Asia. Yeah. you're playing in the manipulation zone of Asia. Okay. And you haven't got to them highs yet, remember, right? So literally you're playing in the Asian zone pretty much. You've just swiped the lows here. So therefore, as you have swiped the lows, you didn't quite get to best execution, but you can take that there. Benchmark 2. That's the most aggressive move, right? Take that there, out. Want to go in again on this candle with the expectation of benchmark 2 because the liquidity is sitting up there. Fine, there you go. That's the trade. After that, you're out. That got there. That was an hour. 7:30 to 8:30. Done. Now we're just waiting for New York. That doesn't always have to be the case because you can stack, right? And if you stack London, you know, Tokyo on top of London on top. That's not quite a stack, but it's close to a stack Friday. Tokyo, hit the best executions. You look here. Tokyo session. Best executions hit once, twice. Didn't go for best executions on sells again. So Friday didn't go for best execution sells. They come down. And then we broke out of the manipulation zone. Like I said, what happens when you break out of the manipulation zone? A 98% chance of getting to this target 1. Target 2, target 1, target 2, all the way down to the benchmark and then benchmark 2. It hits benchmark 2. So that's where we are with London right now. So like I said, all predicted from dealers' spreads within the session. I'm going to call it a day now because this is like my first live stream and no one's been watching. But listen, you got to start somewhere. I'm just trying to like right at the minute, like this tool's not licensed. It's like I said, it's got the information in it, it's got the formulas within it, it's very easy to use. I'm just trying to showcase it at the moment to show that you know, to try and stop you guys looking left and doing all this stuff that has pretty much, if you look left, you have a 50% chance of getting it right. Now I'm not saying these formulas do not align sometimes that give you an edge to 50-50, right? Because they do align, but when they align, it's a coincidence based on the formula. It's just the formula is repeating all the time, so sometimes you get a confluence with previous highs, but generally you can choose any point in a chart. Here we go. I thought I could get rid of price. Any point in a chart. Let's change time frame as well, so I don't know what I'm doing. Any point in a chart that you could say, all right, I don't know where I am, right? So let's bring price down because I don't know whether I need to go highs or lows, but let's just say let's put in 5 or 6 support and resistance levels because I've just gone left on the chart. 1, 2, 3, 4, 5, 6. Now I can tell you now, if you was trading like this, your risk management would be so much better, right? Because you've just picked out some random, literally random lines, and I'm going to call them support and resistance lines depending where price is. I don't even know that price is here when I switch it back on, but let's say we go back to replay and we start our market there, And now we put some bars back on the chart. And like I said, this could, right, here's some bars on the chart, right? We've put our bars back on the chart. Let's come down here. So now let's go for a smaller time frame and try and find where my price action is. Should have done more, shouldn't I? Okay. So here's our first one. That worked. But if you were waiting for price to come down here now, and you know you have just randomly put a line here, on here, or here, you are going to be so tight with your stop that you're going to manage the trade really well. So if you come in here and pop, you have to get long because you've drawn the line. Otherwise, you're just not trading, right? So you've drawn a line, it comes down, you can get long. But it's random, but the trade works. Okay? This is random, but the trade works. Now this one, this line doesn't work, but this pulls back and you can sell it. And this one, perfect rejection candle into your support line, and you can buy it. And it works again here. You can buy it. So we've looked left on the chart, we've dropped down a time frame, we've drawn some random lines, and look how frequently they work. Because price hangs around at these levels with a formula running so, or like all the time, the formula's running all the time, that hundreds of price levels, thousands of price levels of support and resistance are there in the market. Higher time frame, lower time frame, and you can say, oh, the higher time frame ones have more probability than a lower time frame, and that may be true to some extent, but it doesn't change the fact that the higher time frame was driven by a daily dealer's spread recently, not 12 weeks ago. And here we go. Look, I mean, look, you're just trading between these ranges now. You would think you've drawn these off of this information, wouldn't you? You think you've drawn these off of this information. They're so perfect. And yet, they're not. They're random lines. But because you haven't been taught to look left on the chart because it works, which personally I think is 50-50. If you've been taught that it works, it instills some confidence in you to say, okay, if that works, then I can put some risk on, right? I can give it a 30-cent stop. Well, no. You should be treating, if you're looking left and drawing lines, you should be treating your risk like you've literally drawn them randomly, because you have a 50% chance of your trade working out. But look how frequently it does. It's 50-50 though, because for this one that worked, this one didn't. That one didn't. It smashed through. This one was just off. You wouldn't have got it. This smashed through. It smashed through. This one worked. This one worked. This one worked. It's like if you kept your risk at the line and you're saying, look, I'm going to limit order in here if it touches, and if it doesn't, I'm out in an instant. You would just be, look, I'm broken below. I'm going to put a limit order in here to sell. No heat whatsoever. But 50% of the time. And if the risk reward is right on 50% of the time, you can do it. But don't get fooled into the trap that your execution at support and resistance lines, and I don't care if you call them order blocks, demand and supply, whatever, it is not run by looking left on your chart and looking at a candlestick. It is run by the open, high, low, close data within a current or previous, and I mean previous as in just previous, the day before session. That's how it comes in. Now, if you're swing trading, it's slightly different. Like I said, there is a macro version of swing trading that's bigger than what I'm calling macro and day trading. That obviously, this, like I said, this is the same formula. The formula hasn't changed since the 1930s. It's just gone micro and it's gone nano. Before, you used to be able to get a paper chart that was drawn out that was on daily high, low, close. That was it. And therefore, the formula was based on daily high, low, close. Now, your micro, nano, we've got the technologies to do that high frequency trading. It's coming in, but it's the same formula. It's the same formula because the formula works. The fact that you've got so many retail traders in there in the market at the moment that doesn't know the formula means that there's so much more money in the market still going to those people that are actually putting liquidity in the market. If you think of any, like when I say professional trader now, any professional retail trader that's literally self-directed, I can almost guarantee you they are not placing market orders. They are placing limit orders at a price that is better than where it's at right now. Because the formula goes back to it. Look, pick any one you want. There. That's your level. Not this one, or this one. That's your level. And if you want to know, can I sell it up here? You haven't got one. Then you take the spread of whatever time. It's 1 a.m. So it's the Asian Open. There. There's your benchmark. You can sell that because it's going to come off for the rest of the day. It is not any of these random levels that you're putting on your chart. They are 50-50. You can make a living from 50-50 if your risk and reward is correct, but you must treat it like a random entry. Don't go giving yourself a 30 or 50 cent stop on something that is random. And just by saying, oh, well, I'm going for 150 on the downside. No. Don't go for 150 on the downside. You don't get 150 on a downside generally on a day trade because each session is benchmarked. You're going to come back. You're going to come back to a buyer's hold or a seller's hold level in a session. And there are only probably, I would say, not once a week. But when they come, sometimes they come in threes. Trending days, right? Trending days when markets just don't look back. Whatever you should be doing, that it's like the day is just stacked. That is probably, I'd say, once every week, but it doesn't work out like that, right? So it could be 4 times a month, but you could have 2 stacking days consecutively. This is going to be an eye-opener for some people, and I get, people are going to think this is just nuts, but there was no other way of getting information into an application. This is just an overlay, right? Into an application that holds the formula without giving any formulas away. And it's not, I'll put some material together that's going to showcase why, why it works like this. But like I said, you're going to expect this to be a trend day. You just will expect that to be a trend day. But it's going to be over as soon as you get down here. this is your trade, right? It doesn't matter. You don't be in here, because you have a high probability, if you get in to sell here, a higher probability that eye gets taken out by a best execution order up here. Now this day it doesn't, but you don't have a best execution buy really either. There's a couple done here. Like I said, remember this is a zone, there's different banks, it's just like it's in and around here. But look, when you break out of it and close below it, pull back to it, fine, that's a couple of best execution buys, but that's your trade, that's your meat of your move, and that's where you get the hell out. It's not to say you can't have a lower low put in, then it's fine, but generally what you're looking for is for when you're down to the benchmark. Look at this push once, well, 3 pushes, right? 1, 2, 3, 4 pushes down to this one, right? But this is 1, you should be out here. This is you're looking to get long somewhere, and if you wait for higher highs and higher lows, so this one here, that's your last lower low, then you're still in this zone here, right? Flip it, flip this. There's 2 areas here we could go with. We're going to go with the smaller one first. There, your long trade is as soon as you break out of the manipulation zone. Once, benchmark 1, benchmark 2, and done. That's your trade, there or there, depending whether you're a stronger holder or not, right? But the next one is this one, and they will both work. They will both work. There you go. You break out, target 1, 98% of the time. Comes back. Target 2, you're out. Now, where are we going here? We have to kind of see and adjust the spread again. Okay. So there's your trade. You're out. You come back to it again and look. Benchmark 2. Benchmark 2, you are done. That's it. Finished. I, once again, have not, oops, we'll play that game because this is the point I'm trying to drive home. Okay. This level, this reversal level, benchmark is a benchmark 2 from the lows of the London session here, 10:11 GMT. Yep, there they are. Pinpoint. Okay, that's it there. See it in there? If I move this away, there it is. There it is. That is where that resistance came from. Was here. Can I go back 15? Can I go back and find a level that worked now? The answer is going to be yes. Right, there they are. Look. Boing, 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 boing. But it wasn't calculated back here. This boing was was calculated from this. Go there, so yeah, that's that boing. Boing. That's it. And this is just manipulation zone from the downside, because when you take this and this, you got to break out of this before you can start going anywhere. That'll be New York Open, and then you go right. So that's literally a New York Open manipulation to the downside here. Bing. But that's it. That's where that is generated from, and that's where this level is generated from. Again, you can argue whether or not I've got the, you know, the close versus the wick, right? Close versus the wick, right? But it doesn't matter. It just doesn't matter. The concept is, can you see the manipulation being tagged once, twice? Yes, you can. Can you see the breakout? Yeah. Okay, New York Open, flush, comes in, same again, breakout, that's your trade. Working through the levels, that's your trade. Finished. So like I say, this predicted this. This didn't predict this. Okay. Yet the two align. Okay, but literally, if you're doing that, you know, it doesn't matter. Like, that's what I say. Closes, highs. Neither of them align, but still you double top and drop. But that is why I'm saying, if you are using these kind of levels, and remember, they're going to say, I don't know, they kind of rationalize, right? Educators say that these look, when you look back, they're not lines, they're zones. Now, to a certain extent, that is true, and I like to rectangle things out to explain, like, the formula. It's the only really the way you can do it, but every one of them is a line, right? Every one of these is a line. That's 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 a line. And when you get up to benchmark 2, that's a line and that's a line. I zone them because of the manipulation that can occur in these areas when you hit what is liquidity. So when these come in as liquidity, that's simply where the market will turn, but they are individual lines. So if you're looking left and someone says, well, let me think what they say. Right, you need to take the height of the wick to the base of the candle. That's fine. There is how do you say, there is so generally formulas work on closes, but unless you're on exchange, the closed data can be different. That's it. If you're on a futures exchange or the stock exchange, generally the close is all the same. It has to be the same. If you're in Forex, OTC, you don't have a regulated exchange that's recording market data highs and lows. All your brokers can be different. So, but that's how you kind of rationalize that you're not getting pin perfect formulated levels, is that you drag it open. And I think that obviously there's some order block thing saying it's sometimes the first green candle before a red drop, or it's, that wouldn't be one because you've got wicks, that sort of stuff. You have to go looking at different time frames to find one like this, to say, yeah, that's, if price comes back into that works as a drop. If I replay that, I wonder if I can get this to, oh no, I'm already in it. No. If I replay, if I take that from here and drop down too far back, anywhere. Not pretty. Yep. There you go. So it's like I say, you can take that exact swing high if you wanted. Actually, that's a little bit more, but you can tell whether you're drawing these right, because price at the top of the manipulation is acknowledged, and then when you break out of it, it goes straight to target one. You've got it right, so you know that this level is what's coming in. Now there's always some room for error, right? It's a very crude way of getting something very specific across to you guys. So yeah, I know that you have to allow some percentage of error, but the more I do this, the more you're going to see that it's formulated. I can just have a look at GBP USD back. Right, okay. We broke through the seller's hold level, and that becomes because of the aggressive nature of not pulling back to this second zone. That's all it is. That's what the only thing that would give me confidence of getting in to this buy trade is when this breaks out is I didn't pull back to this. I didn't pull back to this one. This one, you could argue, yeah, it did. Could be a double bottom. I like to see a double bottom. This one didn't pull back, which I assume it's aggressive. And when you break out and you start going to the highs, now acknowledged, didn't even close below it. But we closed above it, pulled back to the center, and you'll notice that I don't know how we put this one in. Change the scale, but generally this line here is a line. It's a specific line. This is a specific line. This is a specific line. This is a specific line, right? Oh, I think it might have been there at the time. Oh, okay, I was there at the time. So all right. So this is a specific line. So you can go above it, pull back to it, and go again. This is a specific line, go above it, pull back to it. I zone it out because generally you get a candle that runs into it and it rejects if the seller's hold level is working. Now you've gone above the seller's hold level, which tells me we're coming up for these original orders, which is just clockwork, textbook. That's what I want to see. So, yeah, I very much doubt there was any or many buyers there, but that is what happened. And we are now working our way through into the benchmark. Let me see where we was again. Well, we got we got a higher one. So we've just gone literally. That's right. Yeah, we had confluence with the seller's hold and benchmark one. Benchmark one has been acknowledged in the pullback, ignored on the upside, recognized on the upside, pulled back to the seller's hold level, and then we're off again. So now, literally, in terms of buyers hold levels, debatable. Like I said, there's a little bit of error here, but I would definitely, you could just run that up there right now. Yeah, and I'd keep tracking it. If these highs go higher, 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 like I said, because it does move, it's not just a fib. If it goes higher, I'll go higher. If it stays here, like I said, to the minute, this wouldn't. The only reason this would make sense for a double top at Tokyo, that I'd come down here. I'd much rather get up there before we pull back to this. But literally, we predicted this, right? We predicted that's what's going to happen from that level because we'd benchmarked. We'd hit our benchmark in London to the downside. So now we're going to benchmark for the upside. And we've got one up here and one we're in right now. So what can we do while that's working out? I'll give you guys as much value as I can in this session just to try and bring it home. Let's drop to a 15-minute and let's go back a few days and try and take each one of these days and show you how things can work out. All right, so did we do Thursday? You're going to see a pattern here that you might not have recognized because you might not look at session data, but So we double topped here, that's fine. So in any session, obviously there's going to be a double top. This is when you ignore a buyer or seller's hold level and you go for the double top, and then you have to start doing buyers and sellers hold levels again. And again, for Tokyo, the initial, it's not far off, but we don't quite make it, indicates aggression to the downside. Certainly if we just took that swing, you didn't make it, indicates aggression to the downside, but this would be one that works for an entry, right? So my London lows, I want a discount. I will sell the seller's hold level if they show me that they're selling. If they show me they're selling, I'm in that trade, and it will come out to this point here. Here, there's two things I'm going to do for a target. One is take this target. Yeah, benchmark 1 as the target. 2, you take the macro level on buyer's hold. That's your target. From one to the other. Get out, because that is it. You might be lucky and catch this, right? But generally, you could come all the way to the top and not. But in this case, sellers hold, pinpoint sellers hold, and come off. So that's how you do it. Now, if we're looking in terms of what we said previously in terms of sessions for best execution, we're looking at this, and we did not swipe the highs, which indicates I've got a bit rate problem. I need to increase my bitrate stream. I'll finish up in a second, sort that. Okay, we're back. So we didn't go for best execution on the sells, which is an indication that you need to watch out for sells. I know it sounds odd, but if you don't want a better price to sell, there's an urgency to sell at a lower price. So your urgency to sell at a lower price comes in here and here, 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 here. That's your urgency. But if you're waiting for the breakout here, then you're right to do so. You break out, you pull back, and then you take that trade, which is the same as doing the seller's hold. That's the trade you're waiting for. That one there. Sell that seller's hold. Now, in terms of the benchmarking, like I said, that's different. That's from a spread at the highs and predicts the lows. So your job is to get in where you can, either here or here, for a sell down to here. Okay, and if you're in this next one, you're probably lucky. If you haven't got an order in to get yourself out, you'd probably get that all the way down to the benchmark 2, which is there, literally comes into it. Then you get manipulation. And the reason you go lower there, so this is the pinpoint one, right? That's the pinpoint low. That's the benchmark order. Bang, comes straight back. Now, when you're drawing to the upside, you have a really big spread on the upside, which means you can go lower to the downside. That's why you can go lower to the downside. Yeah, because of that. Because this becomes your manipulation zone. And then as you come lower, yeah, you can bring that in. That becomes your manipulation zone. There, look. Okay, but this was the benchmark, clearly. This is the lows, creating dealer spread at the lows in order to go high. Okay, Wednesday we have you got to look for this level in Tokyo. You've got to look for that. Even if you just call it 50%, you've got to look for that level in Tokyo, because it's a brilliant opportunity for an early bird execution. I know that's not easy for you guys in the US, but yeah. So sellers hold in Tokyo. London just creams on that and breaks out of the manipulation zone. Again, no best execution on buyers. Okay, here you go for it in New York, but no best execution based on Tokyo. Here you go straight out of the manipulation zone. Target 1, 98% of hitting. Quick trade in there, nice range on that, and then you're coming back, and then you go for it at the highs here. So literally similar to what it's doing today. Didn't go there, went for the lows today, went for target 1, come back in and rip to the upside. Now all the while you're in this manipulation zone, this kind of remains valid. Doesn't matter that you've gone to target 1, you're allowed to come back, yeah, and test. You've got to break out again though to start filling all these other orders in. Now let's look at the benchmarks. Benchmarks come in here in Tokyo, which predict the benchmark. Sorry, the dealer spread come in at the highs in Tokyo. It predicts the benchmark, which is down here, which is why you turned around and went back up exactly the same as we did today. It's a repetition, rinse and repeat. It's not always identical, because sometimes we'll go to the top and go to the bottom in the London session and stay there. But you'll see the pattern when it happens. You'll see that this pullback in Tokyo is a great opportunity. You'll see that when you hit benchmark 1 in London, that the buy is a great opportunity, or vice versa. But look, how can you ignore the rejection candle there to get long, right? And if you want to check spreads, look, once you break out, you can wait for the pullback. The pullback will be a buyer's hold level. It just will be a buyer's hold level. Wait for the pullback. Breakout, target 1, pulls back, goes again. That's your trade. Your trade is, when you've broken out, is to take this meat of that move and get out at the benchmark. Now, if you know you've broken out from there, I agree. This is a bit aggressive to get in and chase, because any one of these two levels can work to pull you back to go for a buyer's hold level. So you can wait for the buyer's hold level, because look, it's the same formula. So wait for the buyer's hold level, and when you tick into it, take the buy, limit order in. Literally look at your that's it. 7 times. A sec. And you're literally top ticking your exits, and you are bottom ticking your entry. 7 ticks or pips, whatever, on your stop. 6.99 reward. $54 ticks, pips on your reward. 7 for 54. Bring that back to today. Today's trade. There's a buy there, but you hadn't broken out. Okay. So you're breaking out here and pulling back. The only one that worked is if you want to do buyers hold is this one here. Okay, now obviously that's a crazy level to get into. There's like 2 pips stop, massive reward, but we're going to assume we're going to take this buy out here, this candle here, right? You break out, you pull back to it. When you get long, you're going long there. So that's what we would do. So this is going to be a bit of a bigger stop, but my stop will not be at the lows. There's no reason for my stop to be at the lows. This buyer's level held, this one didn't, right? So if this one comes in, my stop is going to be under here, okay? Not at the lows. No, it's a waste of money. If that's coming back down and buyers hold, don't. I'm not interested in having my stop at the lows. So you're going to get this, and we are going to enter there. Oh, that's exactly right. And I'm going to put my stop below there. But my target is up here, knowing that I could be going for a benchmark 2. Let's see what benchmark 2 is. Okay, so my risk to reward, I'm going up to 2422. It's gone. So here, 14 pips, 42. So that's where you are. Like I said, 14 easy. You know, FX is just not like Nasdaq. If you want some a market that moves, it's Nasdaq. Yeah, Forex for me is like a completely slow market. But yeah, that's your benchmark 2. Your benchmark 1's here. You know, 15, 17 pips in there. The risk was a little bit higher today because we didn't have an ideal pullback, but that one was on a 15-minute, bear in mind. But that's it. When you break out, you get the meat of the move. Let's go 15 minutes. We're done Wednesday. Okay, here's a different one. Look. Tuesday. Oh no, Tuesday. No, Tuesday we did do that. We're on Tuesday. So Tokyo. Now the range here is kind of crazy. Look, I mean we've got one here, so there's definitely spread to be had off here for a benchmark. And here, the previous session, New York run massively, but yet we're gonna repeat the same stuff. Tokyo, and this is basically based on time now. This is not really a clear swing. There's not a clear swing here. It's done off time. Okay. So the reason you're off is because we're working from a box that's generated automatically. You need to go from the low to Tokyo's high. Almost, geez, are we actually going from the New York low to Tokyo's high? Yeah. Okay. Yeah. I mean that's the clear swing. But here, let's do it because that's right. So here we're saying your breakout trade is effectively working, but we're saying we've got liquidity up here around 26.31. It goes to 26.41. It goes 10 pips above that. But like I said, when you're looking at this zone on the London session as it comes in, well, any session really, is that they pepper the orders, right? And what tool did I use before? This one. Yeah, they pepper the orders. The zone may be there. There's going to be orders peppered around here. But at some point, And that's kind of what happens. Up and above, below, we hang around here. Sometimes we just hit and tank, but these orders are just being filled, and that's when you can start running your seller's hold. So seller's hold, come down to this one, to this one, this one to this one, seller's hold, take this one to this one, seller's hold, get rid of that. Yep, seller's hold there. This one to this one, seller's hold here. That's the next Tokyo session. That was a really nice trade. Yeah, so what you've got there is literally you can take the spread from New York's lows and see where we get. Yeah, so you're just benchmarking. The trade was actually from Tokyo lows, and we can do that as well. You can take the Tokyo lows, and yeah, and we've got the two. We've got the best execution sitting here in the benchmark. Hence the push towards the benchmark, held by the liquidity that is at the best execution zone. So, but that's where that is. Your trade for London is to say, right, this is my Tokyo lows. I break out, I pull back. Target 1, 98%. Target 2, just missed target 3. But you're aware that you have this level here, right? So anywhere around here, you should be taking your money, getting out, and then you have a. Let's have a look here. So New York, yep, that's good. So we can pull back to this one. Oh, actually, yep, that's a good level. So that's done in terms of buyers held that level. Come next, buyers held that level. Okay. Come next. Buyers held that level. Come next. Didn't go there. Hence the aggressive move. So take it to there. It's completely ignored on this next day's Tokyo perfect sell. Right. And that's like literally, if you're in that sell, that's exactly what you want to see, is that buyers failed. Right? The buyers literally failed. Even if they were throwing in there, ignored completely to the downside because they're filling this benchmark. Yeah, and from a New York perspective, you would just be doing seller's hold level, selling seller's hold all afternoon, all day. Friday before, there's a buyer's hold level there, but what we're looking at in Tokyo is to see whether or not we have the closes. So the close, look at that. Tokyo session, literally best execution for the buyers, best executions for the sells, spike up for New York Open, and a drop off. That is like literally a textbook day for best execution buys and sells, because you can probably almost take London to Tokyo or London to closes. Yeah, you take that London session low to the London session high closes, and there you are. You're down here. Yeah, that comes down. This is ignored, obviously, to the downside. It's such an aggressive move. If you break out, you can sell, but I wouldn't chase that. In terms of the benchmark here, I'd still go with London because that's a massive open fake out. Yeah. So again, manipulation zone. You want this trade, you get short here. Stop above there. Don't go there. It's too risky. Stop above this candle here. You're broken out. Go with. Hits the benchmark, you're out. In this zone, this line or this line or in the middle somewhere, you need to get out. Gorgeous trade though. What else we got coming up? So yeah, you can get the trend for the past week or so is not been doing best execution. One day we're for sells. So one day we've done best execution for sells and we've just been selling, right? Which doesn't that make sense? One day you've done best execution sells in the past week, and yet sterling has just dropped and dropped and dropped across these sessions, which means your sellers are willing to take a lower price. They're not waiting for a premium price. At the opens, you can identify the demand, and that's exactly all we're doing here, is saying, right, this would have been lovely because this demand is going to come up at the, like, literally you'd so expect this to work, because look, your sellers best execution level is at the New York highs. You would be definitely expecting that to be taken. Definitely. The fact they don't means there is no more sellers at that price today. No one needs to pay that price. So what happens is you check the downside, right? We acknowledge it. It comes back. It comes back to the Tokyo lows and then drops. Target 1, 98% of the time. Target 2, 75% of the time. Okay? Now, we're going to take those highs and we're going to play it the other way, right? Because this is the sessions manipulation zone. The sessions, not the dealer spread of the high of Tokyo. That's different. Dealer spread of the high of Tokyo is here. There's your benchmark. So here's the trade. Target 1, 98% of the time. Pull back. That wick there, you want in. You could trade this short here. That's not chasing, because this is chasing down here. This is chasing down here. That's finished. You want to take from here to here, risking here. That's it. That is it. Now, do we get any buyers hold levels in our first one? No. That is an indication of potential regression. Okay? So no, we didn't. Did we get a place we could order in here? Yes, we did. And the only reason I'm doing that is because it moves it over there. It doesn't matter that it's just marked off over there, right? Yes, you did get a go. You wicked into it. You come out. Again, same trade. That's your sell. You've just got to be aware that the benchmark is driven from the Tokyo high. Boom. Gone. That's how we play that one. Wednesday. Wednesday, we have Tokyo lows to Tokyo highs. Okay. Now, again, context. This is an automatically drawn box. Swing. Okay. Swing closes. Right. Just this one here, whatever. Yeah. So just a little bit of context. But like I said, even if you're ignoring context and you just go with the box, right, that's there, you get the gist of it. You have not gone for best execution on buys. If you're not going for best execution on buys, then you're going to the upside. That's it for the session, probably, or the day, which is what's happened here. So here you've executed best execution sells, but you didn't need the better price on buys, which indicates more demand on the buy side. So more demand on the buy side, you're coming back up. You've broken out once. Let's, if we zoom in to try and get these swings, let's check Tokyo lows.
buyers hold, done. Move to the next. Buyers hold, done. You can buy either one of them, but obviously your breakout is here, right? So you're being aggressive, but you know they're holding. You didn't break the lows, didn't go for best execution, so that's an idea. So that one works. Then this one, you almost argue that one works, right? So these are literally working to the point that you're like, well, I'm not so confident of an aggressive breakout, but buyers hold. Doesn't matter. Nevertheless, each one of these has worked for you. Okay. Now, all you got to do is say, right, well, that's fine. Where am I looking? I've got no macro for a macro seller's hold. So I'm going to take the dealer spread at the Tokyo lows. Okay. And we're going to draw the benchmarks. There you go. There you go. So, broke out. Boom. Pulled back. We know that holds for a buyer's hold. And runs. Your trade is from here to here, or if you're a strong holder, to New York highs. And that is it. Literally like a couple of ticks off, go to the close, there you are. Just drawing. Don't worry about pinpoint drawing, but lows to close highs is generally the way it works. Not wicks, but there's nothing in it there. Don't worry about it. So yeah, and that's your move. GBP 15 minutes, that's your session. That's how these are calculated. That is just it. You can keep on every single day. Slight nuance of the same formula. Look, the highs here. Don't really go for them in the London session, but you go for them in the afternoon. Again, here, context of this low. You go for them at New York highs. You go to target one in New York on the session, but you have ticked out Tokyo's high. Okay, you've ticked out Tokyo's high. Fine. You come down. Best executions here. Yes, there are some, but you drop down to target one. Right now, benchmark. Come to the benchmark. Take the dealer spread. Draw your benchmarks. That's where you're going. When you break out of the manipulation zone, your trade is from here to here, and you are done. Look at the pips on this. 611 to 65. How many pips is that? 40 pips. 40 pips. My risk would be at, where's the breakout? The breakout's here, and I would be zooming in for a buyer's hold. And that would be my risk. So this one. Yep. Yeah, so that's fine. So my risk would, you can almost call it the highs. My risk would be above here. We break out here. That would be it. If I'd got in, no, I wouldn't. But if you'd have got in, let me check. Yeah. If you'd have got in, let's get that bugs. If you'd have got in here aggressively, I'm saying that's a close. You could argue that the safer place was that you're ticked out, but you should be getting in again. You should definitely be getting again with the same stop and taking that. So, I mean, I think you guys look for something that is consistent, works all the time, and this is how it works. It's just a case of, again, context, right? Look at this. It's not great, that swing. what you have got is a swing in the middle here, right? That's clear, and that's the one it is today. All right. You know, when, because if you're looking at the context of everything else, you're going to go roll here to here. We're just off of a buyer's hold level there. So that's obviously a clear swing. New York range, if the box isn't there, you would start it from here, right? You would say the the Asia range is there. That's the Asian range. Therefore, obviously I use closes, so I'd be bring it to draw, I'd be bringing it in here. That's it. And that is why you have the minute. So this is best execution. You top out of Tokyo, you run down to target 2. Target 1 98% of the time, target 2 75% of the time. This will be a buyer's hold level, a seller's hold level in New York that comes down. This will be a seller's hold level, a buyer's hold level in New York from London lows, and then you go off to new highs. Now let's look at that from a benchmark perspective, right? How can I get in from a benchmark perspective without just shorting this candle here? Because if you shorted this candle here, you'll be expecting to go to there, which is not happening because that's a session spread. So you're coming in from the highs of London to the spread of London, and that's where you're going. So your target there, you're short. It's got to be aggressive because it doesn't come back today. And you're going down to the London lows. Now, if that's too aggressive for you and you don't want to risk that, that's fine. You're going to miss out on that particular trade, but your benchmark is already hit. So what you have to be careful is say, right, well, okay, we didn't execute any buyers at this level, right? We went straight through. So if we're looking at where we would execute the buyers, they were ignored, yeah? So we're some, but they're ignored. So the only way you can have a pop at this trade now is by saying, sellers, I'm going to sell the seller's hold level here, which works, but you need to take it in to, you can only target the buyer's hold level, right? Which in Forex 89 to 76, you know, there's a little bit there for you. So yeah, again, I don't know. Again, this is a context swing. There is one there the Friday before. There it is. There's your orders. Best execution, sells 1 2 3 4, messing about, comes straight back down. Goes for best execution on the buys, but doesn't quite make it. Obviously doesn't need to. The indication that we are going up there would be the fact that the sellers failed to hold. Yeah, had a go, didn't make it. Buyers hold level, seller's best execution hit. A trade down there, and then if you're going to London lows, London highs to the close, same formula works. Bang, bang. And the reason it's stopping here is actually from the London dealer spread, ignoring the dealer spread in it's this. Yep, it's ignoring that. So, and you can see there isn't one there, right? There's no spread there. There's no spread there. The spread's here, and that's where it goes. So your trade is stopped from the early London session because of what? The open. So we open here. That's just an open manipulation. Unfortunately, not a lot you can do about that. It went to the best execution for London. That's it. You've got to bear that in mind. It's not like you couldn't have drawn it. You're just literally Tokyo and London was the same at the lows. The highs of London was here. That's it. You've got to be aware of that. That's a sell opportunity up there. And look at that when it did. So that's it. But yeah, still your dealer spread was based off of London highs for your close down there. Yeah, I mean, I don't know how many times you need to. So this is a stacking day, beautiful stacking day. This is what I mean by a trend day, right? This is a trend day. You can, like, sellers hold all day long. In this example, you are going to take that and that. Yep, there's your spread. So we, again, to get the point home, we do not go for best execution sells, which tells you that sellers are, institutions selling on behalf of their clients are willing to take a non-premium price today. They're willing to take a lower price for their sells, which means they've got a ton of sell orders. So if you've got a ton of sell orders, what are we going to see? Let's get rid of our buy orders. Right, done. So there you go. But we're staying out of this manipulation zone right now. Okay, but that's what we're going to do. That's done. There's two things we can do right at this point. One is look for buyer's hold. There's a buyer's hold level. That's your least risk entry you can take. Okay, does that actually align with the dealer spread? Right, the dealer spread is from, I'm using this high, I'm taking this low, close, okay, broke out, pulled back to it. This is our entry for our seller's hold. So we're in here. We are in short of these wicks going in. Target 1, 98% of the time. Target 2, 75% of the time. Benchmark. Benchmark holds. Top of the benchmark holds and rejects. You're going down to benchmark 2. Where are you? We need to squeeze. Again, I'm using the Tokyo high, which is this one. I'm going to these closes. Oh, these closes. Down, down, down. There you are. Benchmark 2 hit, finished. But for New York, you was out anyway. And then this becomes, like I said, the lower lows here is the manipulation coming in to the swing in Tokyo. Okay. But like I say, you don't really need to worry about whether this holds or not unless you're looking to literally limit order or reverse on the trade. The point is that your trade is in here, targeting here. Your stop is above the seller's hold level at 15 pips, and you're targeting 65 pips, or you're targeting strongholder. If I can get it. Oh, overlay. You're targeting 120 pips. Yeah, so that's the deal. That's how we trade cable, and you don't need to really, I know people that trade Forex go looking through every single pair, but if you specialize in one of the majors, mate, you got it. I mean, you just literally can keep taking these levels, man, and there you go. It's like, again, take the level, look for the best execution. Don't look for the buy on this strong bar. Give it 20% and say, yeah, do you know what, I'm not getting in yet. I'd rather sell up here pretending I've drawn a level in. Like, literally do that. Just take the Tokyo high, somewhere up there, throw in a line and go, I'm going to sell that line. Goes a little bit above, it's fine. Some tight risk in there, sell that line and do it. And then, here what we've got, right, is we do get seller's best execution. And we get buyers at target 1. So here what we're doing, again, is to say, right, I'm expecting sell orders up here and we get them. Here I fail. Now, this is a session spread. So session spreads take a longer period of time to work out than session higher spreads. So, meaning this is predictable from this Tokyo session, right? You run through it or you eventually get there. But again, how we're going to get into the trade is different. We're going to have a little closer look here and say, okay, there's 2 things I've got to look at. Is, does this swing in London give me a seller's hold level? Yes, it does. I can trade that red bar there. Where am I going to get out? Is 2 things. One is you can run all the way back here to the lowest low, to the highest high. Macro. Whoops. Yep. So you're targeting this zone here. That's the macro one. If you put this on a higher time frame, that's where you would be. Obviously, you've got these buyers hold levels working all the way through. So that's one target. The other target then is to say, well, benchmarks from the highs. Take the high, take the closes, put it in. There's your benchmark. Your trade, we're already in here from a seller's hold level, right? So you're in that bar, risking above it. And yeah, because that seller's hold level's there, right? So you're risking just above there. No, it's not above the candle, right? It's above the seller's hold area, right? That's the whole point. Stops above candles and swings. Stops above a seller's hold level makes sense. So that's your seller's hold level. But we are going from the highest dealer's spread. We're coming in. We break out. Pull back to seller's hold. There's our trade. This is our interest here. 1, 2. We're in the benchmarks. Finished. It's finished for the zone. Finished for the day. Finished for the session. Right, come on. I must be getting boring now. Final one. Tokyo, highs and lows. There you go. We come down to the buyer's level. Come down to the seller's best execution level. We stay in the range all day. Look, that is literally a range. That is what can happen. That's like, I've got nothing else to do today as a dealer than execute my client buy orders, which I've got a few, and my sellers have got a few. I haven't got a bias today, a job to do, any more orders. My orders are balanced on the buy and sell side pretty much, and then I come back in. The only trades for a retail to consider at this point, if you look again, London, look at the London swing. Look at the London swing. Yeah. There. Same old. Take the London swing, goes in, comes out. If you took the London high to low for tomorrow, that's probably where you're going to come in for tomorrow's high. There you go. London high, down. It's operating all the time based on the current prices of the session, the previous session, previous day. That's it. But it's calculated, not from... Yeah, you're calculating a high and low point from the previous session, not using it. You're using it as the basis for your formula for your calculation. Now, what could you do here if you were trading it in terms of benchmarks? You're going to know because you didn't break out. You faked out here. You didn't break out here. So the only thing you can do on these days is sell or buy the hold. Is buy or sell the best execution levels in line with what the dealers are doing, or you are looking for like to get in on a bit of action, which is Tokyo seller's hold. You can take it from the seller's hold level down to the best execution level, or you can take it from the lows to the highs, and you can take the London buyer's hold level into New York, and you can take that buy into the highs because you know you have the target box there, right? You can't assume that's going to break out if you're buying down here. That's got to be your target. You can target after that, but not. It's not today, right? It's just a swing trade. That's it. That's the last one I'm doing. That hopefully should give you some idea of how not looking left can be profitable. Now, with regards to this tool, it's not licensed. Right now, I'm not trying to sell it. I'm trying to showcase it for interest. I don't know. You're all probably so brainwashed with looking left that it's going to be a tough job to get you out of that. But like, all I can tell you is that the algorithms that are using these formulas are current. They're using current data. Like I said, current as in today. I am looking here, right? So at this point here today, I am not using anything else other than the current price action that's just happened at the high. Literally all I'm going to do, this is all I do, is draw that and that. And I would like for price to come down here, and if it did, I would get in somewhere around here. All right, that's what I'd be looking for. That's it. That's my trade. I said I'd stop. I'm still going on, right? But that's it. Right now, support, resistance, trade. For 500 quid, done. That's it. $500. That is it. So all you got to do, stop looking left. Cheers, guys. See you soon.